Hello financial fans, welcome back to another stock analysis. Today we'll be covering Texas Instruments stock ticker TXN. Texas Instruments is a technology company that designs and manufactures semiconductors and integrated circuits, or ICs. The company was founded in 1930 and is headquartered in Dallas, Texas. Texas Instruments is known for its wide range of products including microcontrollers, digital signal processors or DSPs, analogs and mixed signal ICs, and sensors. TI's products are used in a variety of applications such as automotive, industrial, communications, consumer electronics, and medical devices. For example, TI's microcontrollers can be found in a range of electronic devices from home appliances to smart grids, and its DSPs are used in audio and video processing as well as wireless communication. TI is a leader in the development of educational tools and resources for STEM, short for science, technology, engineering, and math education. The company's calculators, such as the TI-84 Plus, are widely used in classrooms and by students from mathematics and science classes all over the world. Additionally, TI provides resources and training for educators to help promote the use of the technology in the classroom. They are currently sitting at a $156.2 billion market cap, and in 2022 they generated a revenue of $20.3 billion, and the dividend yield is currently sitting at 2.87%. 37% of their revenue comes from industrial, 27% from personal electronics, 20% from automotive, 8% from communications, 6% from enterprise systems, and the remaining 2% from other various products. To determine the final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25%. That can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $2.8 billion in 2013 to over $10 billion in 2022. The average EBIT growth was 16.7% on average, meaning a 5% deduction and a margin of safety. The margin has also gone up significantly, going from 23.2% in 2013 to 50.6% in 2022. The average margin growth was a very high 9.5%, meaning a 5% deduction and a margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over the years, going from $1.20 a share in 2014 to $4.96 a share in 2023. The average annual dividend growth was 17.3%, meaning a 10% deduction and a margin of safety. This with a payout ratio of 49.9%, which is no change in the margin of safety on this metric. The final two ratios are the debt to EBITDA ratio and the return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. And for Texas Industries, this is almost a 0% debt to EBITDA ratio. It's just slightly above it, but it qualifies for the 5% deduction and a margin of safety. This with a very high return on invested capital, one of the highest I've ever seen, sitting at 60.4% rather, which is a 5% deduction in a margin of safety. Looking very good so far for Texas Instruments. Let's go look at the valuation models next to determine the intrinsic value of the company. The first model we'll be using is the discounted cash flow model. I've imported free cash flow of Texas Instruments going from 2013 to 2022. The average growth rate in free cash flow annually during this period was 8.65%, and I'm projecting an expected growth rate of 5% annually in the free cash flow over the next 10 years. With this percentage, we can determine the future free cash flow for Texas Instruments and determine the terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%, leaving us with a sum of free cash flow of $121.5 billion. And to get our equity value, we have to add the cash and equivalents and subtract the debt. But since they are very close, we get the same equity value, sitting at once again $121.5 billion. All we have to do to get our valuation out of this model is to divide it by the amount of shares outstanding, giving us a price per share of $134.15, which is a 22.5% downside from this model. The second model that we'll be using is the dividend discount model. I've imported dividend payouts of Texas Instruments going from 4 years ago to the current year. The average growth rate in dividends during this period was 12.7% annually, on average, and I'm projecting expected growth rate in their future dividends of 7%, and we'll once again be using a discount rate of 8.5% in this valuation, leaving us with a dividend discount model price per share of $353.81, which is a 104.5% upside out of this model. The third model that we'll be using is the Graham's revised valuation formula. In this model, we'll be looking at the earnings per share that Texas Industries is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the standardized yield of AAA corporate bonds, sitting at 4.4. And we go by the theory that a company of no growth always has a PE of 7. Taking all of these metrics into account, we get a fair value of $171.78, which is very close to fair value, only giving us a downside of 0.73%. The fourth model that we use is the multiple valuation. In this model, we look at similar companies to Texas Instruments, look at their stock price and their earnings per share. This way we can determine the average PE multiple in the industry, which in this case is 15.32. All we have to do to get a fair value is to multiply by the earnings per share that Texas Instruments is generating, which is $9.61 a share, giving us a fair value of $147.22, which is almost a 15% downside of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean. And the metrics that we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield of the past 5 years, and on average it has been sitting at 2.3%, while currently dividend yield is sitting at 2.88%, meaning that it's currently undervalued on this metric. Doing the same for the PE ratio, we can see that the average PE ratio of the past 5 years has been sitting at 22.18, while the current PE ratio is sitting at 18.01 rather, meaning that it's also undervalued on this metric. This gives us a fair value of $215.01, which is a 24.25% downside of this model. Upside rather. If you want access to all of the models that I use in my videos, you can check in the description for my Patreon link. Anyways, getting my self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $204.39. Our margin of safety we determined earlier, using a standard margin of safety of 25%, deducting about 5% for the debt to EBITDA, 5% for the EBIT growth, for the margin growth, for the return on invested capital, and 10% for the dividend growth, leaving us with no margin of safety at all. Then, the fair value is exactly the same as the average out of all of the models, and with the current price of $173.05, we get an upside of 18.11%, indicating that it's currently a buy. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.